Good afternoon, everyone. My name is Shakima Appleton, and I am a volunteer on the Philly SHRM Programming Committee. We want to thank you for joining today's webinar entitled Financial Wellness and the American Dream in 2018. Before we begin, I'd like to introduce Elena Lozemoser from Westchester University, Graduate Assistant Director of the School of Business, our annual webinar sponsor.
Hi, everyone. Thank you, Shakima. I am here to share information about Westchester University's Masters of Science in Human Resource Management. We also offer a certificate in Human Resource Management. Both are AACSB accredited, SHRM aligned, and offer top value, and both are 100% online graduate programs. You can complete your entire human resource degree in a 100% online class format, part-time or full-time. The MS is 30 credits, which is 10 courses, and the certificate is 12 credits, which is 4 courses. Both operate in 7-week terms, and we offer 5 terms per year. You can complete your entire classwork on your weekly schedule around your work and family commitments. One 3-credit course is approximately $2,000. This means you can earn your entire degree for thousands less than at other comparable schools. The Human Resource Management program at Westchester is accredited by AACSB International, which is the premier global accrediting body for business schools. The program is also aligned with the curriculum standards developed by the Society for Human Resource Management, or SHRM. Students who meet the prerequisites are eligible to apply for the SHRM Certificate Professional Exam, SHRM CP exam, in their final semester or final year of the program. The degree does prepare you to advance within the human resource profession at the highest levels. The curriculum focuses on compensation and benefits, employer and labor relations, ethics, global human resources, human resource metrics, leadership and change management, and workforce planning. If you qualify, you can skip the GMAT requirement, and students come from all kinds of educational and professional backgrounds, not just business. This was just a very quick overview of the certificate and the MS degree in Human Resource Management, so please do reach out with your questions. I'm happy to help you. You can contact me at hrm@wcupa.edu. Thank you so much for your time today.
Thank you, Elena, and thank you, Westchester, for your sponsorship. During today's presentation, if you have any questions, please feel free to send them via the question box of the GoToWebinar panel, and we will read them aloud to the speaker at the end of the webinar. We also want to remind you that you are eligible to receive 1 HRCI credit and 1 SHRM Professional Development credit for attending today's webinar. You will receive a follow-up email after the webinar with a survey link that must be completed in order to receive the certificate for your credits. Once the survey has been completed, the credit forms will be emailed to you within 1 week. All slides will be sent to all attendees after the webinar. Today's webinar will feature Emeka Argu, founder and CEO of People Joy, and Steve Granizino, National Director of Affinity Programs at Annie Mac Home Mortgages. Thank you both for joining us today.
Hi, everybody. My name is Steve Grandizio. I am the head of our Affinity Program at Annie Mac Home Mortgage. We also run a financial wellness program that we bring into the workplace, and really happy to be on this webinar, sharing it with you today.
Hi, good afternoon, everyone. My name is Emeka Ogo. I'm the CEO of People Joy. People Joy offers student loan repayment assistance for employers looking for creative ways to attract and retain talent and address financial wellness within their organization. Today, Steve and I are going to talk to you about financial stress in America, as well as the impact of financial stress on your employees and you. We're then going to go into more specifics on defining financial wellness and specifically talk about how student loans and home ownership impact wealth creation. And finally, we're going to give you some more information on how you can help your employees and then help you tie your financial wellness program into your bottom line. Afterwards, we'll open up the session for Q&A. Thank you all for attending today's session, and we're looking forward to a very informative and productive presentation. So let's talk about stress in America. In a recent study done by the American Psychological Association in November in 2017, the most common sources of stress were defined as the future of our nation, where 63% of Americans felt that they were very stressed about that. And if you turn on the news any day, you see a lot of conversation about what's going on in the world and in our country, and there's a lot of stress about that. Surprisingly, or not surprisingly, the second most common source of stress was money, followed by work, our current political climate, and violence and crime. Now, when you look at financial stress, the reason why it's very important is obviously uh, it's something that people deal with and take to work. And when they bring that to the workplace, it leads to lower productivity. So, what I wanted to first do is give you a deep dive into more information on financial stress in America. A lot of Americans are placing their retirement dreams on hold. A recent report was done by the United States Senate on a Special Committee on Aging, and they forecast that the number of Americans working over age 55 is going to increase from 35.7 million in 2016 to 42.1 million in 2026, making up nearly one quarter of the labor force. Now, why does that matter? Obviously, hiring and retaining older workers is fantastic for companies. It helps employers retain valuable skills, addresses workforce shortages, it increases workplace diversity, which can contribute to improved outcomes. However, here's the challenge. Many older workers are struggling to prepare financially for retirement, so they're working not because they want to, but because they have to. In fact, over one-third of Americans have no retirement savings whatsoever. It gets even worse for millennials. Millennial employees are burdened by their personal finances. 37% say that they have issues with personal finances that have become a distraction at work. 64% are stressed about their finances, and 79% say that student loans have had a moderate or significant impact on their ability to meet their other financial goals. How many of us have heard the quote from Benjamin Franklin that a penny saved is a penny earned? Here's the harsh reality. Americans are not saving their pennies. Over 29 million Americans are living paycheck to paycheck. Now, here's some surprising statistics that you may not know about that group. 7 in 10 are struggling to keep on top of their bills. 1 in 4 are behind on bill payments. Now, when you think about this segment living paycheck to paycheck or struggling to keep their bills, a lot of us think that the common misperception may be that they're not working or it's folks living below the poverty line. The reality is that 3 in 4 in this segment are employed, and 1 in 4 earns over $60,000. So this is when it comes to financial stress, it is really salary agnostic. You have employees who are earning well over $60,000, sometimes even over $100,000, who are living paycheck to paycheck. Now, what does this mean to you as an HR professional? As I mentioned earlier in our presentation, a lot of it comes down to people bringing this into the workplace. A PwC study found that 52% of employees are stressed out about their financial situation. 2 in 5 employees spend 3 or more hours per week dealing with personal finance issues. And in a recent SHRM survey, 7 in 10 HR professionals indicated that personal finance challenges have an impact on their employees' performance. So, what are some signs of financial stress? Oftentimes, it's not as apparent as a health issue within the workforce, but there's some telltale signs that you can identify that will give you a sense that if your employee is dealing with financial stress. How many of us have seen our employees taking out loans against their retirement savings, either a 401k hardship withdrawal or taking out money to buy a home or pay for college? A study done by the Defined Contribution Institutional Investment Association found that 40 cents of every dollar contributed to a defined contribution plan by savers under the age of 55 eventually leaks from the retirement system. So people are taking out money, borrowing from Peter to pay Paul, so to speak, in order to deal with current day financial issues. How many of us have seen employees asking for payday advances? A study by Statistica.com found that there are more payday lenders, 20,500, than McDonald's and Starbucks in America. Oftentimes, companies' employees are going to payday lenders as the borrower of last resort if they're not able to get a payday advance, and they're paying interest rates upwards of 400% for that. Having unexpected absences. SHRM's financial stress report found that 37% of HR professionals said that employees at their organization missed work in the past year because of a financial emergency. Now, going on, other signs of financial stress that you may have seen are people spending time dealing with personal finances while at work. As I mentioned earlier, 39% said they spent 3 or more hours each week dealing with issues related to personal finance. Medical issues that could have been avoided through preventative care. A Bankrate survey found that 1 in 4 Americans refuse medical care because they can't afford it. Having a second job, 32% of workers have a second job. So when you look at this, and hopefully this has set the stage for financial stress in America, what are some solutions that we can offer our employees to help them with their financial stress? One solution is financial wellness. When you look at wellness, it's everyone's familiar with health and wellness, and you've seen companies really focusing on the quantified self and helping their employees become healthier by giving them incentives and rewards for living a healthier lifestyle. Companies have seen a direct impact on their bottom line in terms of less employees reporting out to work because they're sick, less employees, and improved healthcare costs. But companies are starting to realize that when it comes to financial wellness, it's also very important. But it's also important for us to define what financial wellness actually is. And we define it as financial wellness programs are programs that educate employees about the financial risks that they face and help them by providing tools that manage those risks. Prudential has gone a step further and defines financial wellness as being protected against risks that are difficult to predict and may have significant financial consequences. So we're going to dive into what those risks are in a little more detail. The first risk, as Prudential defines it, is the loss of income due to premature death. 31% of Americans believe that they would be significantly impacted from the loss of a primary wage earner within a month of his or her passing. The second risk, as Prudential defines it, is loss of income due to illness or injury. A study showed that a 35-year-old leading a healthy lifestyle has a greater than 20% chance of becoming disabled for 3 months or more during his or her working career, and a 38% chance that the disability will last more than 5 years. Out-of-pocket medical and non-medical expenses. 46% of Americans do not have enough money to cover a $400 emergency expense. Emergency visits have climbed in the United States to a record high of 141 million visits in 2014, which is the most recent data from that study. And obviously, we're 4 years later, so you can imagine it's gone up a lot more since then. And lastly, outliving assets in retirement. The country's retirement savings deficit is estimated to be at more than $4 trillion. And that's the focus of our conversation today. We want to talk about what are the obstacles and roadblocks that are causing today's workers to outlive assets in retirement. And there are two specific things that we want to talk about today. One is student debt, and the other is the lack of home ownership within America. So student debt has grown to $1.4 trillion in the United States. It impacts 7 out of 10 people entering the workforce, and it's growing at a rate of $2,726 per second. And obviously, the impact of that debt are that today's employees are delaying buying a home, and they're putting less towards their retirement. So a common misconception is that the student loan problem is a millennial problem. It's a problem that only people within in their 20s are dealing with. But the statistics show that of the 1.4 trillion in student debt, and it's actually one and a half billion. They just announced the new numbers yesterday. It's age agnostic. So what you'll see from this screenshot here is that what you have here is debt over the years. So you see that from 2004 to 2015, the student loan balance has gone up nearly 5x. And there's a breakdown here of what that looks like. So at the bottom end, in the dark blue here, those are student loan balances by age group, and that's the under 30 group. And what you'll see here is that 31% of the student loan balance is held by uh, people under the age of 30. 33% is held by people between the ages of 30 to 39. 19% is held by people between the ages of 40 to 49. And 17% is held by people over the age of 50. So when it comes to student debt, it's something that is really everyone's struggling with it across different age groups, and it's for a number of reasons. Some people went back to school to pursue a master's degree or a PhD, especially if you remember during the housing crisis in 2008, 2009, a lot of folks went back to school to retrain themselves. There's also because the cost of school has doubled over the last 10 years, you have parents who've taken out Parent Plus loans on behalf of their children, and so the parents are on the hook for paying for student debt for something for their kids' education. So another statistic that is interesting that you may have not known is that any additional dollar of student loan debt reduces retirement savings by 35 cents. So if you think about someone who's at work, they just started working, they have on average, they're paying $400 a month towards their student loan. If you calculate the rent that they're paying, along with the student loan debt that they have to pay, along with living expenses, oftentimes they don't have much left after that. And so they're not putting towards their retirement, they're not taking advantage of that match. In fact, Fidelity ran a study that showed that 41% of employees below the age of 39 were actually cashing out of their 401k after they left their job. And that number gets exacerbated because of student debt. And so now I'm going to pass it to Steve, who's going to dive a little bit more into the housing situation and how that impacts retirement.
Yeah, so gosh, there's a lot of issues, a lot of things that people are dealing with, a lot of financial stress. 62% of your workforce right now, while we're on this webinar, is dealing with, is stressed out about their money, right? And but things still haven't changed as far as people's definition of the American dream. Most of your workforce today, again, while we sit here, either owns a home or aspires to own a home. Almost 9 out of 10 people don't want to be renters for the rest of their lives. And they understand what kind of role home ownership plays in creating wealth. It's not just about the picket fence and their dogs running around in the yard, but it's also about gaining wealth over time. They've seen their parents, they've seen their grandparents own homes, and they want to be a part of it. This statistic's incredibly interesting. The fact that older homeowners, the median value of their assets is $273,000, and it's represented by about half of that being their equity in their home. While at the same time, older renters have median assets of only $3,000. It's a significant difference. And 44% of those older renters are paying rent, which makes up a third of their income. Makes it very difficult to accumulate wealth when you're a renter in that situation. So, and how does wealth get created? through home ownership? Well, according to NAR, the National Association of Realtors, there was a 5.4% annual appreciation in the 41-year period from 1968 to 2009. Pretty significant. As you can see by the chart, it really started to hockey stick in around the 70s. That's when home values really started to rise, and even in the 2000s, that's where it really shot up. Obviously, we had a little bit of a bubble, and values came back to life a little bit, but even with that, if you look at the mid 2000s to today, many markets across the country have not only recovered their value, but are starting to exceed the values that they saw at the peak in the mid 2000s. The Case-Shiller 20-City Composite Home Price Index essentially is the Dow Jones Industrial Average of home prices. It takes 20 major metropolitan areas around the country, not just the urban, but the metropolitan areas, and it measures their values over time. And as you can see, we've exceeded the values in this index from our high point, and many markets across the country have far exceeded their top values. So let's look at a little illustration of how somebody can accumulate wealth through home ownership. So even using very conservative numbers of a 3% year-over-year appreciation rate, which historically is pretty conservative, home's still an amazing investment. So let's say you buy a $250,000 home. And we're going to look at, when we look at this illustration, we're going to start to look at the laws of compounding interest. So because you're starting with a value of $250,000 today, it's a little bit different than, let's say, putting money in a 401k, which is also fantastic, or a 403b. You start your 403b or your 401k today as a young employee. Maybe you have $1,000 at some point. Well, if you get a 3% growth in that money in the first year, you made $30. Even if you get 5%, you made $50. Let's say you had a couple $1,000s in. You're only talking about $100 or so in growth. But because when you're buying a home, you're talking many multiples of that. You're starting at, in this scenario, $250,000. That 3% appreciation brings your value to over $257,000 after year one. So that's a $7,500 increase. $15,000 2 years later, so 24 months later, and $273,000, so $23,000 in home appreciation. The other thing you can see here is millennials who are waiting to buy a home. They may be swimming upstream a little bit. They're getting further and further away because home values continue to go up. While they're doing that, they're making their mortgage payment each month. So instead of rent, they're making their mortgage payment. So, the most popular loan for first-time home buyers is an FHA loan. It requires 3.5% down. So in that $250,000 scenario, you're taking out a loan of a little bit more than $241,000. 12 months later, your balance is less than $238,000. 24 months later, it's a little over $234,000, and 3 years later, so 36 months later, you're at $230,000, $352,000. So you're looking at $43,000 in equity just in 3 years based on this scenario. But unfortunately, millennials, and I know, Mecca mentioned that it's not just a millennial problem. Certainly student loans, as we saw in that chart, aren't just a millennial problem, but millennials are waiting. They're waiting to get married longer. They're waiting to have kids longer, and they're certainly waiting to buy longer. So according to Zillow, typical first-time home buyer now rents for 6 years before buying. When we looked at that chart a couple slides ago, and I'll go back, back in the 70s is where we started to hockey stick a little bit. It's where values really started to go up. Well, back in the 70s, they were only waiting, let's say, 4.5 years, 3.5 years to buy a home. Okay. So they were entering that home buyer market much sooner than they are today. And in fact, the average first time home buyer today is 33 years old. So part of the reason why millennials are waiting to buy is what Emeka hit on earlier, is the student loan crisis. Maybe, the next bubble to hit America. In 2015, students who took out student loans graduated with 70% more debt than those just 10 years earlier. Just 10 years, 70% more debt. And the average is $34,000. And if there's any parents of kids who are either in school or about to go to college or have just graduated, know how expensive college is today and how much there's pressure. Obviously, you need to get a degree, or you want your kids to get a degree, but you certainly don't want them starting their work life with that much more debt. And your younger employees right now are strapped with that. So, this is an interesting study by Apartment List. It shows that college grads with no debt, I'm not sure how many of those actually exist anymore, but college grads with no debt are able to save for home ownership at about 4 years faster than college grads with debt. So you can see how that mirrors the length of time, the additional length in time that millennials are waiting to buy from that Zillow statistic. And it doesn't help to not send them to school. That's not a solution. It in fact takes even longer for folks without a college degree to save for home ownership. So that's not our solution. And I work for a national mortgage lender, Annie Mac Home Mortgage. We're not helping either, although we don't set the guidelines. Fannie Mae, Freddie Mac, and FHA are not helping with regards to this. So not a lot of people know this fact. So let's just look at this for a minute on the screen. So regardless of the payment status, as we're on this webinar, you have employees who are sitting back at the office and they have tens of thousands of dollars in student loan debt. And some of them are in deferment. They're not even making payments, or they're making very low payments right now. Unfortunately, when we go to qualify them for a mortgage, even if they're making no payments or a very low payment, this is how the FHA requires us to figure out their debt to income ratio. We have to take the greater of 1% of the outstanding balance of the loan. So in the scenario at the bottom of the screen, $50,000 in outstanding student loan debt would equal a $500 a month payment towards their debt to income ratio, or the monthly payment reported on the credit report. So whatever's higher. So even if the monthly payment is low, we can't use that. We have to take 1% of the balance. $50,000 sounds like a lot of money, but gosh, with attorneys and doctors, and there are people with way, way more student loan debt, a couple $100,000 of student loan debt, and we need to use 1% in order to qualify them for a mortgage. The only time we can use the actual documented payment on the credit report is if that payment will pay off the loan over its term. So with regards to millennial buyers, that's not often the case. Usually the payment that they're making today and that they're required to make on their credit report will not pay off the loan. And that's different than credit cards that show up on their credit report, personal loans, auto loans. We can use the actual payment on the credit report. So we can use the minimum monthly payment on credit cards. We can use the actual monthly payment on personal loans and on auto loans. So big difference, and it's playing into part of the reason why millennials may not be waiting because they want to wait. They may be waiting because they have to wait. And it's delaying the American dream. So we've already seen that most people still have the definition of American dream, part of it being you own a home. And as you can see, when applying for a home loan, debt to income ratio is king. It's even bigger than credit score. Credit score is huge, but debt to income ratio really drives my job and my loan officer's job in approving people to buy homes. So again, we talked about swimming upstream. This is swimming upstream. Every year you wait, you may get further and further and further away from actually buying a home, which just compounds the stress and the stress over money in people's lives.
Thanks, Steve. So now that you have a good overview of financial stress in America and the impact of student loan debt and housing, one of the things I wanted to impress upon is why this matters. One, and then two, how you can help your employees manage their financial risk. So when it comes to outliving your retirement savings, oftentimes when you're going into your retirement, your home is your biggest asset. For most folks outside of their 401k, that's what they're relying on to live off of in retirement. They're going to sell their home, they're going to downsize, and then they're going to use that to live off of. If you're delaying buying your home, you're delaying thousands. Steve showed that simple example of 3% a year growth of $50,000 in equity accumulated over 3 years. Imagine if you're starting to buy your home 4 years later, you're missing out on that $50,000 in equity. And if you've lived in Philly or been in Philly for the last 4 or 5 years, you've already seen the explosive growth in housing over these last 4 to 5 years, well over 3% a year. So just imagine if you didn't own a home, just missing out on that upside that you could then take that money and put towards retirement. So you have this combined stress of student debt weighing on your ability to save for retirement, as well as your ability to own a home, which is the American dream. So again, going back earlier to those four areas of risk that Prudential defined as far as what financial wellness means, I think financial wellness 1.0 begins with education. So when you look at these four areas, the loss of income due to premature death, loss of income due to illness or injury, out-of-pocket medical expenses and non-medical expenses, as well as outliving assets in retirement, the first thing that you can do for your employee is provide education. And it starts with helping them learn how to keep a budget. If you think about it, where do you learn how to balance a checkbook, maintain a budget? Where do you learn the understanding of what credit is and why it matters? It's not taught in colleges or universities. It's not taught in high school. So oftentimes it's learned through what I call the school of hard knocks. You get a credit card early in your career or in life. You don't pay a couple bills, your credit score drops. You're not able to. No bank or credit card company is going to extend your credit going forward. So you realize that you have to boost your credit up. When it comes to budget, oftentimes, if people are living outside of their means, you're not able to create that 6 month emergency account, 6 months savings account that will allow you to, withstand shocks, financial surprises such as out-of-pocket medical and non-medical expenses. So giving your employees access to tools that help with budgeting and credit counseling would be very helpful with addressing that. And there are a lot of free resources out there. Within Philadelphia, for example, there's a nonprofit called Clarify that helps folks with understanding budgets and counseling and things of that nature. So these aren't tools that you really have to break the bank for. And then again, when it comes to loss of income due to premature death, illness and injury and expenses, helping your employees choose the right life or disability insurance. Oftentimes, employees are thinking about these when there's certain life events. They bought their first home, they had their first child, they just got married. Helping your employees understand, term life, whole life, what the differences are, what makes sense for them, and then who within their life, would be susceptible to financial issues if something were to happen to them, and helping them think through that. I think it's really important. And oftentimes, employees don't understand what those resources are. So connecting them with the right people there is also extremely helpful. And then when it comes to, again, illness and injury, the right healthcare insurance plan. When it comes to the open enrollment period, helping them decide through the different healthcare options that they have, whether they should be on a high deductible, things like that, is super important.
Yeah, and Mecca, just to carry your point forward as far as using an organization like Clarify, there are free ways to be able to deliver some financial wellness. Whoever prepares the taxes for the company or for your nonprofit, they may be able to come in and do a budgeting workshop for your employees. Your 403k or 403b or 401k provider could come in quarterly and help with asset allocation and do some different retirement planning lunch and learns for your employees. The benefit that I run with our mortgage company is a free program. We don't charge the companies, and we come in and do different things on credit and home ownership and helping answer those questions. So there's a way to be able to increase the financial aptitude of your staff without even tapping into the budget, quite frankly.
Right. And those are all great points. And then specifically when we're talking about outliving assets in retirement, helping your employees understand their options around student loans, whether that be refinancing, whether that be income-based repayment plans, but helping them make that correlation and understand the longer they take to pay off their student loans or the more debt that they have, the less likely that they are going to have assets in retirement, and driving awareness around that. And again, as Steve mentioned, there are free resources around that. People Joy will come in and visit with companies and give them advice on their employees' advice on managing their student debt. And also with home ownership, helping your employees understand the value of home ownership, um, giving them options around that, helping them provide that education. Buying your first home is a very stressful, it's very stressful. And oftentimes, if someone can have help from their company to help guide them through that, they're very appreciative of that, and it shows that the company, has empathy and understands their situation and wants to help them achieve that American dream. And then, obviously, most importantly, retirement. So, companies I think are already doing a great job with the 401k match. You see a lot of companies also offering auto escalation, where they're every year they're incrementing that amount that they offer their employees, but then also education around that, helping them understand not only the importance of putting money towards their retirement, but keeping money in their retirement, so that we bring down that statistic that 41% are cashing out of their 401k, or 40 cents eventually released from the retirement system through education, because it doesn't make sense for them to put the money in if they're just going to take it out 3 or 5 years from now. So again, as I mentioned, Financial Wellness 1.0 begins with education, and there's a lot of free resources and tools that you can offer your employees to help with that. Now, let's talk about that next level, if you want to go, which I call Financial Wellness 2.0, and that's really around investment. So if working with your company to put to actually invest in the financial wellness and the financial readiness of your employees. So one of the options you can do is offer financial health coaching. So the difference, or more specifically what financial health coaching really involves, it's one-on-one counseling. And the reason why that's important and why your employees might value that is that uh, when it comes to financial literacy and understanding budgeting and managing, a lot of times it's a very personal issue to employees, and they're not as comfortable sharing their personal financial struggles in a seminar like format. And so if you're able to connect them with coaching, and these are people who are licensed professionals that can work with your employees on a one-on-one basis over a period of time, very similar to a fitness coach in helping them set goals and achieve them, it could really help it will really help drive your employees' financial wellness, and they now have an accountability partner to help them reach those goals. And obviously, group life and disability insurance, offering these programs to your employees and also giving them the options to add additional coverage is a great way for an employer to be invested in helping their employees withstand those financial unexpected financial emergencies. HSA employer contributions. One of the biggest risks of outliving your assets in retirement are health issues, unexpected surgeries and things that people don't plan for. Oftentimes, if their standard insurance won't cover them. So giving your employees, helping them understand their options around HSAs, maybe perhaps making matching contributions to those. These are accounts that they can, that go with them, that they can use in retirement, especially if they're investing in. So it helps them to not have to dip into their 401k or other resources to pay for unexpected medical issues. Employee loan products. So we talked about earlier about payday lenders. There being more payday lenders than McDonald's, and employees asking for payday advances, or even worse, borrowing from their 401k or cashing it out and using it like as a piggy bank. One 2.0 initiative that employers can offer is giving their employees access to loan products that they may not have access to. So if they're not able to go to a bank because of their credit, their only other option is going to be to go to a payday lender or borrow from their retirement. Many employers are giving their employees options to access to money that they wouldn't have access to avoid them having to go to payday lenders. Walmart, for example, recently launched a program where they're giving their employees access up to a week's worth of pay in advance so that they don't have to go to payday lenders. And they're actually tying that in with a budgeting tool so it doesn't become a handout and it doesn't become something that gets abused, so which is also really important. And then student loan assistance. So again, as we talked about earlier, many employees are struggling with student debt across different age groups. Many employers are starting to offer student loan repayment assistance where they're making matching contributions to their employees' student loans, very similar to a 401k match, and giving their employees opportunities to pay that down faster. And then mortgage assistance. So we've also seen employers where they're helping their employees achieve that American dream by helping them put that deposit down. Oftentimes, putting that 5, 10, 20% down really takes a long time for employees, especially if they have other debt and obligations to manage. And then we also talked about it earlier, that 401k match and auto escalation, which many employers are also doing, but again, tying it in with auto escalation and perhaps restrictions on the amount that an employee could borrow, so that they're not pulling away, withdrawing from their assets before retirement. So now I want to jump into making the case for your financial wellness program, especially when it comes to financial wellness 2.0, which requires an investment from your employer. Oftentimes, especially as HR professionals, we're becoming more data driven, where we really are being asked to tie in the benefits that we offer with a return on investment for the employer. The reason why we want to do this is because we don't want the CFO to CEO and CEOs to feel that he or she is taking a leap of faith on our benefits. So what are some of the things that we can do that are metric driven to make the case for our financial wellness programs and really get the employer's buy-in on offering such benefits to employees? One is industry benchmarking. So the best way to really make the case, a strong case for financial wellness benefits, is to first look at where you compare versus the industry, versus your peers, versus your competitors. Are you investing in your talent and in your benefits the way that your competitors are? And there are certain tools and resources that you can use to help really drive that home or measure that. One of the things that we've used is, or we've seen, is a study done by the Hackett Group, where they actually do benchmarking of where you are versus your peer group and what is world class. So if you find through certain benchmarks that you're underinvested in versus your what's world class or your leader, the leaders in your peer group, that's a strong case to go to your CEO and CFO and say, hey, here are benefits that we can offer that would add value and actually put us in line and make us more competitive with our peers. And then also tying it to retention and recruiting. The Wall Street Journal just published a report showing that the unemployment rate has dropped to 3.9%, which is the lowest it's been in over 17 years. And so, especially when it comes to hiring and retaining and attracting the best talent, oftentimes it's becoming a lot more expensive. So if you're able to tie in your retention and recruiting efforts to certain benefits, it really, again, helps make the case for return on investment. With student loan repayment assistance, for example, employees generally will sign a retention agreement agreeing to stay for a period of 12 to 18 months. So with that benefit, you're able to show that tie that contribution to actually improving retention and as well as people joining the company. And also studies show that when it comes to a more engaged employee, a more productive employee, and a less stressed employee, happiness makes employees 12% more productive versus unhappy workers that are 10% less productive. So being able to show, and you can measure that through surveys of your employees before and after benefits, before and after receiving a financial wellness benefit to get a better sense of their understanding of their feeling around it and how engaged they are. And again, being able to tie that to the bottom line. So we really appreciate your time today on the call and hearing our presentation. And now we want to open it up for questions.
We will now open it up for questions. If you have a question for our speakers, please type it into the question box at this time.
So obviously, we had a lot of materials here, and I think one of the things that questions we always get are, how do you make this equitable? What about folks that already own a home or folks that don't have student debt? When it comes to financial loans benefits, oftentimes we find that when it's a one size fits all, it ends up being a one size fits none. And I think what we're starting to see are that employers are making efforts to provide benefits that maybe only impact a smaller segment of their workforce, but making sure that every segment of their workforce has a wellness benefit. So for someone who's going to retire in the next 10 years, making sure that you have a 401k match. For parents of children, giving them 529 contribution plans so that they're able to put money towards their kids going to college. And then for millennial employees, student loan contributions and mortgage assistance and benefits like that to help them with achieving their American dream and paying off debt. So we're seeing companies being a lot more creative with the benefits that they're offering and the flexibility of those benefits to really meet the various needs of a very diverse workforce.
And if there are questions after the fact, I know it happens to me all the time. I come up with a great question on my ride home from an event. If questions do come about after the fact, how can folks who are on the call get those questions to us?
If there are any further questions, feel free to email them to info@phillyshrm.org, and I will forward them over to Steve and Emeka.
And our information's right here in this last screen, so you can certainly send them to us directly. They can go through Philly SHRM as well, and we'd be happy to answer any of those questions. Maybe even put you in contact with some good resources that are out there if you want to kind of get the ball rolling on a financial wellness program at your workplace.
Okay, and at this time, I'm going to pass it over to Shakima to close out the webinar.
Thank you again to today's speakers for taking the time to share their knowledge with us. Thank you to each of you for joining us for today's webinar. As a reminder, please look for the follow-up email with a link to the survey. Be sure to complete the survey in order to receive HRCI and SHRM credits, and visit www.phillyshrm.org to register for other upcoming events. We encourage you to check out the Philly SHRM website for updates on all of our upcoming programs. On behalf of Philly SHRM, thanks again and enjoy your afternoon.